Hey, what's up guys? In this video I'm going to review Berkshire Hathaway and try and see if it's a good deal right now. If you're new to the channel, my name is Dan. I do a lot of investing and stock analysis videos here. So if you like that kind of thing, hit that subscribe button so you don't miss any videos. Alright, let's jump into it. So we all know about Berkshire Hathaway, Warren Buffett's company. The stock is currently trading at about $2.90 per share. Talking about Class B shares. It's priced at about 25 times next period's earnings. They do not pay a dividend. And the market cap is about $664 billion. One thing I think you have to be aware of is, again, Seeking Alpha posts these PE ratios a lot of times based on non-GAAP earnings. So again, non-GAAP earnings don't follow the accounting rules. So I really don't like to look at those as much. When we talk about GAAP earnings for the trailing 12-month period, Berkshire's valuation looks a lot better, doesn't it? PE ratio of about 6.6. We'll have more to say about the calculation of Berkshire's earnings in just a few minutes. So we all know Berkshire is a very diversified company. Here are the earnings by segment for the most recent year. So they have insurance income from underwriting, also have investment income. So when you write insurance policies, you collect the money now, you pay later. That gives you a float that you can invest. That has really been the secret to this company's success over the years. They also make a lot of money from railroads there, about $5.1 billion. Utilities coming in at about $3 billion. Manufacturing, service, and retail about $8.3 billion. And then what you have here is investment gains and losses for $32 billion. This includes things like unrealized gains and losses on securities that Berkshire owns. So if they own a stock and it goes up in price, it's counted as part of their income, and that's where it goes right there. Now they also have a loss of about $11 billion in other. That was a goodwill impairment, so it's an accounting write-off. It's really important to understand these unrealized gains or losses and how they contribute to Berkshire's earnings. Unlike other companies, Berkshire is a holding company, so a big portion of their gains and losses for any given year might come from changes in stock prices of stocks they own. It didn't used to be this way. Prior to 2018, if you owned a stock and it went up in price or went down in price, that did not necessarily affect your net income. So when we look at Berkshire's net income over time, there's kind of a structural break before 2018 where you see slow, steady increasing net income, and then in 2018 all of a sudden net income drops like a rock and then skyrockets back up the following year and so on. So it's very volatile now. So when you look at their net income for the trailing 12-month period, it's close to $104 billion. The company is only valued at $664 billion. That looks wonderful, but you really have to understand that's not likely to recur. A lot of that is unrealized gains. Alright guys, so here is Berkshire Hathaway's pretty safe balance sheet if you ask me. Liabilities-to-assets less than 50%, debt to assets less than 13%, so very low leverage unlike a lot of companies you see in the S&P 500. The liquidity ratios are pretty safe. Check out the description below if you don't know any of these ratios. You're talking about a company with about close to 17% of their assets are just raw cash. So Warren Buffett ready to buy up any deals that come up. So very nice balance sheet, quite safe. So we usually think of net income as a more reliable indicator of a company's profits than operating cash flows. But I would say there's going to be an exception to every rule. And for Berkshire Hathaway, because of their huge gains and losses from investments, I think it's probably better to look at operating cash flow as an indicator of their profits. And as you can see in the blue here, operating cash flow is nice, steady growth, coming in at about $40 billion most recently, for close to 43 there. So we are going to more anchor on that number as a more reliable indicator of the profit they can bring in. It's worth noting Berkshire's financing cash flows are often negative because although they don't do dividends, they have started to get a little more aggressive with their buybacks, and I like to see that. Alright guys, so at this point in the video, I'm going to use an intrinsic valuation model and figure out a fair price for Berkshire Hathaway. As I mentioned previously, in the trailing 12-month period, they're reporting earnings of over $100 billion. That's not going to be recurring, guys. A lot of that is due to the big uptick in stock prices over the past 12 months or so. So what we want to focus on is earnings from operations from their actual businesses. That's what I'm going to be basing my forecast on. I'm going to lay out all of my assumptions in a spreadsheet, going to walk you guys through that, and then figure out what it's worth based on that. Let's get started. So here's what I have for Berkshire Hathaway. I have revenues from our base year. I'm going to assume they will grow. I'm using analyst forecasts. We don't have a lot of analyst forecasting, but we have a few here, and they're predicting about 5.8% growth, then 5.1, then 4.8. After that, we don't have any data. So I will be a little pessimistic, a little conservative. I'm going to assume they continue to grow earnings at about 4%, then falling to 3 and then 2. If that is true, we have a stream of revenues starting about $248 billion this year, growing to about $356 billion in 10 years. Sounds more than reasonable to me. But to get from revenues to profits, we have to know what our margins are going to be. Now, I know recently they reported this amazing 41% margin. Again, I think a lot of that is driven by temporary fluctuations. So I'm going to go with the 10-year average, 17.4% margins. I think using that 10-year average is probably the best way to go. It's a very mature company, and they have so many different businesses. It would be a lot of work to use a bottom-up approach and estimate margins for each segment. That would be almost impossible. So anyhow, we have this stream of net income, and it starts at about $45 billion. And as I mentioned, not going to be $100 billion again for a while. If that is true, the last step is to subtract reinvestment needs. Based on the growth they're having, which is not very high, they're not going to need to have high reinvestment rates. They are a little more capital intensive than other companies that are more into tech. So this reinvestment rate may strike you as high. But again, they have a lot of capital intensive businesses. So I'm going to go with 20%. As their growth falls, it's going to drop to about 14.8%. That gives us our free cash flows. Let's see what the company is worth given these cash flows. Alright guys, I will assume that after 10 years, they can grow cash flows at just 1% per year. Not unreasonable. I think it's a little pessimistic, but then again, as you get larger, and Berkshire is quite large already, it is hard to sustain large growth. So the company's value really depends on your required rate of return. I put up values for anywhere from a 7% discount rate to a 10% discount rate. As you can see, it's going to be a good deal almost no matter what. If you want a 9% return, for example, Berkshire would be worth about $304, making it close to 5% undervalued right now. Given their safe balance sheet, given their diversification, I don't see any reason why we need to require a very high rate of return. I think it's a buy. Alright guys, here are my final thoughts on Berkshire Hathaway. First thought is to smash that like button. Really helps support the channel. I do appreciate it. Okay, but seriously, Berkshire is one of the few companies that's not leveraged up right now. They have a very safe balance sheet, and they have a very diversified group of businesses that are run well. So overall, it's a very nice company to invest in really at any point. But right now it seems pretty attractive. The market seems to be overlooking Berkshire. I mean, you have a company here with a market cap of about $660 billion, and they're looking to earn about $45 billion next year, according to our calculations. So that's a pretty attractive valuation ratio. And when you factor in the expected growth, and you also have to factor this in, guys, if we have any market downturns, they have the cash ready, so they'll be able to take full advantage. So I think it's a great stock to hold for that reason. If you are thinking about holding cash because you think the market is overvalued, a lot of people do feel that way, but you're worried about inflation, you want to own some kind of asset, Berkshire Hathaway seems like a nice play. You own a very nice business, but they also hold a lot of cash that they can use to get good deals if we have a market downturn. So yeah, I think Berkshire looks nice right now. I would say I'm going to buy some, but I already own some. So those are just my thoughts. Let me know what you guys think in the comments below. Thank you for watching.